This is Traders Workshop with Adam H. Grimes. Hello, welcome to episode 21 of Traders Workshop, Learning to Trade, Digging In. I'm your host, Adam Grimes. You can find more of my work on my blog, adamhgrimes.com, and you should also follow me on Twitter at AdamHGrimes. So this is the second episode with Tom and Alex. We sat down. Alex had spent some time with my trading course, and you should also, by the way, go to marketlifetrading.com and sign up for a free account. Check out the trading course. 30-ish hours of video, hundreds of pages of PDFs and exercises. And this is what Alex is working through. So we sat down to do a level check. We were checking the microphone, and Tom realized that we had actually lapsed into a pretty interesting conversation. And so we just pick it up in the middle of a sentence and go. With no further ado, here we are.
It partly out of a sort of self-defense, partly because, frankly, I assume this is just taking levels. It's not.
Tom was like roll. So yeah, just
rolling.
That's fine. No, we're rolling.
No, that's good.
Yeah. So I mean, my initial reaction to Unit 1 was, I think it did a very nice job of outlining, shall we say, the ontology of like the worldview you've got here. It's very different from what I know. To be honest with you, I'm not very comfortable with it right now, simply because, we talk about Mr. Market, but you clearly believe Mr. Market is alive and well and proceed from a totally different understanding of the market, which is it seems to lead itself, or it's got a mind of its own, whereas everybody else that I know in the academic or professional community is much more comfortable with an idea that prediction for future market moves comes from some valuation, and valuation should tie to kind of a real world story.
Right.
And I did not get that from what you've provided in that first unit.
Okay.
But obviously I'm open to it and kind of interested in sort of understanding why that possibly would work.
Well, the why is a fascinating question, and I don't know why. And I think I have spent a lot of time thinking about that why. And I have to tell you that I'm continually, that's one of the fascinating things about doing what I do is like I'm baffled. Every year there are several points where I catch major inflections based on little patterns of lines on charts. That's nonsensical, right? Yeah. The fact that well, it's what's the date today? I don't even know.
It's the 14th of November.
14th of November, 2018. And so we just had a major meltdown in crude oil, for which we were positioned short because of a simple consolidation pattern like we cover in the course. And natural gas just exploded. We missed the trade for reasons that we will discuss. Basically, we screwed up, but analytically, we saw that move develop. These are major macro moves that we got from patterns on charts. And these are isolated examples. If anybody's telling you an isolated example like this, you should be like, you're probably full of shit. You're probably making it up. But this has happened year after year, time after time after time. And why? How? I don't know. And it's very easy for me to, there are a lot of people that we talk about woo-woo and magical thinking where they think there's some like secret of and we talked a little bit about this the last time we were together. It's easy for me to see how people get there because what I think, and I'll tell you what I think is the rational explanation, it's unsatisfying. And it also doesn't, frankly, seem quite sufficient. Like this stuff works far better than it seems like it should. Why does it work? Well, I think because what actually moves markets, we could have a whole discussion about does valuation matter. And I think the way my mental model of markets is, in the long term, valuation matters. Okay, like you have this theoretical valuation that every market is kind of moving toward, but we know that rubber band, and you know this from your fundamental work, that rubber band can be quite long and quite stretchy, and sometimes like it's almost not there at all, and nobody really has a good understanding of how that happens, right? Nobody in the academic world really fully understands why price diverges from value, or should it even? As a, like I say, if you go to the extreme, then you shouldn't even do any analysis because it's all baked into the price, which we know is not really true. And also, if nobody did analysis, how would price reflect value? If you start to think in the limit with some of these things, it gets a little bit crazy. But I think what it is that in the long term, we're moving toward that value, and there's another piece of that. But in the short term, it's the only thing that moves price is people buying and selling, which means it's people making decisions. It's people it's people who are probably a lot smarter than I am looking at crude oil and understanding weeks before I had any idea anything was going on. There were probably traders selling crude oil, and they were probably doing it in a way. And it's interesting because when we talk about like the kinds of the history that we've looked at, the commodities from the Middle Ages, and even the price charts from not charts, but the price records from antiquity. The interesting thing is that the guy sitting in front of a computer screen selling crude oil today is doing it with the same emotional patterns that some guy would have done sitting beside the Euphrates in 400 BC. Like it's still people making the same mistakes. It's still people making the same kinds of decisions. I think that's what's going on. And I guess that's not, I don't know that. I try to be very careful about what I think I know in terms of probabilities and statistics and what I'm just making up. What I just told you, I think I'm mostly making up. I can't think of another explanation. It's like either people figure out something is happening and they move the market, or maybe there's something else going on I don't understand. The other part of value, I think, is that value moves. We need to remember that. Like people think that there is the magic valuation number, but that valuation number is moving around, and it's moving around in response, among other things, the movement of the market itself. Like reflexivity, Zoros talks about reflexivity, right? That price movements can actually influence fundamentals in a kind of reverse feedback loop. So I don't know. I mean, I feel like I just spouted a lot of nonsense, but I don't have anything else to say, really, but nonsense.
Valuation, the fundamentals are a moving target in the sense that people are trying to get ahead of them, right?
Yeah.
So it's not, you can't always necessarily peg a stock to like a specific price. Like this is the valuation. And like Adam was saying, there's the band. Like at a certain price, it becomes like an arbitrage, right? And you can buy the company and liquidate it for more. And then at a certain valuation, it's just, more obviously a bubble. But there can often be a large sort of in between. And that's sort of the realm most of the market lives in.
And I guess, to challenge my own historical basis, which is probably more of a fundamental approach, when I say I'm more comfortable with fundamentals, that concept of comfort suggests a kind of emotional reaction, or the fact that, frankly, a money manager may feel more comfortable explaining to his institutional individual client something that has a sort of real-world basis.
It's a story.
Right. It's a story, exactly.
People like to have a story.
On the flip side, however, and this is actually one of the learnings from our first call, you put under the umbrella of technical analysis, like quantitative trading.
Right, I would, yes.
And they probably don't have that much faith in a lot of the fundamental approach, too. They're almost looking for statistical correlations and such.
You can do quantitative work on fundamentals, but yeah, a lot of them are using pure price.
And so I guess the same challenge comes again, which is you've got high-power equipment, people who quit a physics PhD to go into this work, who presumably can catch these pricing connections that you're talking about, and frankly, at much greater speed and horsepower than you could possibly imagine.
Right.
So how are they not beating you to every trade?
They probably would if I chose to trade, if I chose to play their game. Like I have, for instance, I tell you a great way I could lose money would be to try to high-speed scalp as a human. And there are people, years ago, there were people who would sit in front of the computer screen and make 200 trades a day. Like I believe you could do that. I was never doing that kind of trading, but today it's all computerized. And people who are playing that game have no sense of how much faster the computer is. It is funny when you talk to people who think they are scalping, they have no concept of how fast the silicon brain is against your...
I'll be honest, I don't know what scalping means.
Okay, scalping, that's a good question. And call me on things like that when I assume. So scalping is a style of trading that you try to just take a very, very quick trade. So for instance, you might be watching a stock bouncing around up and down, and you might buy it and just plan to make a few pennies. Yeah. And of course, the flip side is if it goes against you by 1 penny, you're hoping to be out. That's extreme scalping. But you're really, and it came from, you could certainly do it on the floor. Like somebody trading on the floor of the old trading pits, you had no transaction costs to speak of. You had a small, but and you could buy and literally get out on the next tick if it was against you. So people try to replicate that at home, but today that is, to my thinking at least, very much the field of those mathematicians who have figured out. And you said quit the physics PhD. There are plenty of people. The thing about this business is that literally some of the smartest, best educated, it doesn't sound good if you don't say the word educated correctly, right? The best educated and best capitalized people in the world, that's who you're playing against. You're playing against people who completed multiple PhDs and now they're making some trading system. And so, you don't play their game. You don't you don't try to play the very short time frame. Just like I would also lose, if I try to play against Warren Buffett in the valuation game for buying whole companies and holding them for decades, I'm going to lose there. Where I know I have an edge is in trades that last a few days. That seems to be, and you can prove it to yourself number-wise if you go and play with the numbers, but there does seem to be, for whatever reason, a kind of sweet spot where there seems to be a little bit of money lying around to be picked up.
And obviously you have a track record, presumably, that speaks to that not quite instantaneous time frame.
Yeah.
Again, on the flip side, I assume that physics PhD dropout has the wherewithal and resources to test their trading strategy over a longer time frame that would hit into your window.
Well, they would, but to that person might not want the risk of holding overnight. For instance, that could be a very legitimate reason. If you had the access to the infrastructure, and that's the other thing about the speed game. People will co-locate servers, so you're paying extra money each month to have a cable that's a few meters shorter. You're not going to get faster on the keyboard to overcome that. You're talking the speed of light through a copper cable, and so that people need to have that kind of speed. If they have the infrastructure, if they have the capital to do that, then why would that person want the risk of taking something overnight? They're thinking in a different way. Me, because I started out as a poor trader that had a weak computer with a phone modem access, and did not have this. I never started that way. I never traded that way. I never thought that way. So it's a completely different game. And that person probably, I guess one of the other things that I would wonder about is maybe there are forces here that really could not fully be arbitraged away. And what I mean by that is, for instance, let's say we had a commodity that we knew always went up in the spring. And so we're talking seasonal influences here. Well, if you know it always goes up in the spring, how do you trade that? You buy before the spring. And when people figure that out, what's going to happen? Everybody's going to buy before the spring. Price is going to go up before the spring. So you eventually get rid of, you arbitrage away that influence. And it's possible that maybe there are, the reality is markets have to move from one price level to another. One way or another, that they have to do that. Crude oil is worth $80 a barrel, and then something happens and it's worth $60 a barrel. And it's a gradual something happens, but we still have to make that movement from one price to another. And at least in my not so casual inspection of the history of financial markets, that movement has always happened in some relatively predictable ways.
I think totally fair. I think the other question that I would ask you, and not to lump you in with, frankly, the penny stock faxes I used to get at my old job, but if you have a fail-safe way to create outsized returns, why are you telling the world?
It's not fail-safe. So I think that's one of the places where you and I agree completely, is that the only way you make money is by taking risk. I don't know any way to make money in the financial markets that doesn't involve risk. And frankly, involves significant risk sometimes. Anybody who tells you otherwise, they're scamming, they're lying. I also think that there is an aspect of it that is, when you talk about discretionary trading, it's one thing if I have a purely algorithmic system. So I have a set of rules that tells me precisely what I'm going to do. Well, that set of rules is probably not going to work 5 years from now. Not in the same way it's going to need massaged. And I'm not going to give you that set of rules. And in fact, some of my analytical tools that I've developed, I'm not going to give you, I'm not going to tell you how I produce that squiggle on the chart for some of the things. There's a proprietary aspect to that. And part of that's just like, maybe part of that's not real, but that's something I developed that I'm not going to share. But the framework here is, I think, so universal. Maybe it goes back to there being forces that can't really be arbitraged away. If we continue down this road and you see markets like I do, you're going to trade differently than I do. You're going to make different decisions. And we see that, like Tom and I trading together, we'll look at a pattern and Tom knows exactly how and you probably, with a reasonable amount of effort, could say Adam's going to do almost exactly this, but it's not going to be exactly that. And what you want to do is a little. So there's always that little bit of human discretion and because I've always structured my business with that aspect of discretion, that's never really been a concern for me. And it's not a secret sauce. People are like, why would you give the secret sauce away? We could also talk about personal reasons, like we're doing this because I like to, I like to work with people. I like to teach. I like to, part of it's a creative thing, like, my blog. I like to write stuff. But at the end of the day, the question's valid. And it really comes down to, I don't think you make this edge go away by sharing it. Certainly hasn't. And somebody basically shared this framework with me. I was not the first person to ever get it by any means. And I've shared it with a lot of people, and it works just as well as it did. So objectively, I haven't seen any, knock on wood.
So I assume there's somebody hitting you up for royalties.
Mm-hmm. No, I mean, so much of this is like basically, and it's not even public domain. It's like the kind of ideas that you really couldn't. You could trademark
how to think.
You could trademark a silly name for a pattern. You could trademark some framework or some indicator name. But Tom's right. It really is like you can't trademark how to think, and you're providing a way to understand the movement of the market and to think about managing risk.
Makes sense.
So you went through the first module.
Mm-hmm.
And part of
Is that the right term, module?
Yes, module. Module, section, chapter.
Yeah.
On the site we call them modules. A lot of that deals with just getting familiar with charts and setting them up. How did you look at charts before? Or were they just sort of incidental, like they were on the page when you pulled up the Yahoo Finance page? Like, what did you think of charts before? And has that changed at all?
Yeah, I think it's fair to say that with every, at least personal trade I've made, mm-hmm. I have always made reference or at least or looked at the chart, not for a particular pattern, but perhaps for some, I keep using this word, comfort, that if I'm, making a long trade that seems to be buying into some sort of dip. So again, that's like not a momentum thought, but really I'm hoping that I'm buying at an undervalued situation. To be honest, I don't make any short trades in my personal book, but at no particular length of time, whether or not it was a 5-day or a 1 month probably didn't factor in too much, and I certainly wasn't looking for specific patterns that sort of play to a playbook.
So when you saw a chart, when you pulled up the chart, it could have been a line chart, a bar chart, a candlestick chart. It didn't really matter.
Invariably a line chart.
You just kind of wanted to see which direction the line was going.
Yeah.
If the line was going up, would that make you hesitate?
Yes, I think so. I can't say with.
So the chart mattered.
Yeah, it seems like it matters.
It did, but it's probably that second level check against some other catalyst, explanation, valuation. So hey, it's I make a connection to how I make my sort of NFL picks for every week. I go to one source and become quite confident in it. Then I sort of check that against a second source. That second source is always the second source. But it still makes me more validated, more likely to make the trade if that chart.
So you wouldn't buy that chart? Is that what you're telling me?
So pick a spot, like
just like
that's pretty consistently.
Just like let's say we're looking.
Correct.
Okay.
I would be more reluctant to make that trade. I can't say conclusively I wouldn't. I'm just saying it would make me more reluctant.
What were we looking at here?
Well, that's the Dow Jones right before 2000. So that would be a good time. That would be a good example. Okay. But this might be. That would be something like if the chart looked like that and you pulled it up, you're like, I might buy that because it's not going up, right?
Correct. Okay. Or like it looks like a slight dip against a larger trend.
So what you're actually doing is you kind of wanted to be a contrarian.
I guess, yeah.
And you were using the chart to quantify the behavior of the market.
As a secondary source.
Right.
Yeah.
But how else would you have done that without the chart? Like let's say you were not allowed to. So you do the valuation for this company, or you have this idea, and you think it's worth $104, and you got to at least know what the current price is, because if it's 200, then you don't have a trade, right? You can't look at a chart. You think it's worth $104, it's $60. You can't look at a chart. What else would you look at? How would you have some idea? Because maybe it's 60 and maybe
presumably I'd have to have some sort of price history, even if it's a list of prices. Otherwise, how would I ever know what I'm trading against?
Right.
But yes, I think it's fair to say that I do look for probably that drop, to buy in the drop. And again, that's typically the only kind of trade I'm making in a personal portfolio, as some sort of validation. I would imagine, I can't say exhaustively, right? I don't have my entire history of looking at charts or looking at data to mind, but I think most of the times I've executed a trade, it's against that secondary level of comfort, again, that word, that comes from, that price history, which a chart tends to be the best form, to see.
I think there are kind of two broad ways of reading charts. One is you just kind of like almost squint at it. You say that's going up or that's going down. The other is, and we actually may not have a lot of examples in here, which will tell you something. The other is to really look at the details of each of the candles and like to really look at the relationship. So like you would get in here and you would say, that day is just a little bit higher than that day, and that so you're looking at the nuances of each chart. And you probably did notice there's the chart story work in the first. Did you spend some time with those?
I didn't actually actively do any of the. I mean, I went through the homework exercise, but I didn't actually pick out too many trades to analyze.
I would actively do those because, and here's something I guess I have never really said this clearly in public, but I think that kind of detailed looking at the details of each bar is complete crap. I think that this is, and there's a whole industry where people believe that each single tiny nuance of the chart is significant. That's just a radiator. It's New York apartments. And before you got here, Tom and I were talking, I said, I know that's not true because there are plenty of charts in the past that have like weird things because I made a trading mistake. And I push the thing around, intraday and sometimes daily. And if I did that, how many more, for example, there's one ETF that has a very strange spot in the middle of the day because I was hedging a big position and I hedged it the wrong way and had to flip the position and had to bang in it. So like there's this weird distortion in the chart. And if you were looking through for significance, you'd say, oh, what happened? Some guy made a mistake. Yeah. And if that happens just with little old me, how much more must this happen on a macro scale? Or, maybe the index goes down because some fund bought a big basket of stocks and needed to hedge the beta. Who really knows? So I think that what you have been doing all along here with your chart reading is actually what Tom and I would advocate. You have been probably the one thing that I would change is I'm much more likely to buy something that looks like this, but I don't want to really, so I just showed him a chart that's kind of going straight up, but I don't really want to buy there. I'd rather sort of buy on a pullback, we call it, or right. just a pause.
But that's your start and end point, right? That is your only source.
That is my only source. Is I look at something like this, and so now we're looking at a chart that's going down, and I would say that's going down. I think it's probably, and the assumption is, and we'll refine this a little bit. I'm grossly oversimplifying. I think it's going to continue to go down. So I'm going to look for spots where I can get short without getting hurt. Or I'm going to look for spots where I can get short, and if I'm wrong, if I do happen to make this trade and short here, I'm just pointing to the bottom of the downtrend. How can I know pretty quickly that I made a stupid trade? So I don't have to lose a lot of money. I've got to lose some money. I've got to risk because we had that discussion. You got to risk some money. But what I'm doing here is looking for an intact trend and just looking for a pause against the trend. And then I am aware the kinds of patterns that I'm aware of are this is kind of normal trend crap where it's just bouncing around. But then here where it really, and this is maybe a little too visual for a podcast, but where it really goes wacky and extreme, that's typical. There are a handful of patterns that show how trends end. Now, of course, the discretion comes in with what do I do with that information? Where exactly do I get in and out? But I don't think...
And of course, your time frame. I mean...
Yeah.
Something at a short enough interval is a straight horizontal line, right?
Yeah,
so I don't know what the window is here, and hard.
I think those are daily
hard in a
bars.
Podcast really to get people engaged on it.
We're looking at a daily chart.
Yeah, but from the period of October through July of the next year, effectively.
So and again, there are plenty of people who would like to be in and hold for that whole, multiple months. But for me, I'm happy to take out a week, which on a chart like this, you won't even see.
So, Alex, but if you're presumably buying a position to hold for a long period of time, like several quarters or years, what does a pullback of a few days or a couple weeks?
Well, the answer is I've probably been a little bit imprecise, which is I'm looking at a chart that is probably somewhat consistent with the holding period I'm looking at. So. Okay. If I'm looking to hold months, my guess is my chart at least incorporates months of time, certainly not minutes. So So I guess, and it's because it's not the primary source of information. I'm not particularly pedantic about the methodology. Mm-hmm. Again, it's a comfort item.
Yeah,
it sort of makes me feel that much happier to put money on the line,
Yeah. Interesting, because it would raise the question Like I think one of the problems we always have when we're making money, well, it's performance attribution to use the formal word, but like you're making money, where does the money come from?
Mm-hmm.
And wouldn't it be curious if you were making money from your chart reading and not your fundamental analysis? Like perhaps
Yeah.
what if all along that was a bigger aspect of it than you might have thought?
Hard to say. It is very hard to say. Though I can definitely, I think, express times where the chart gave me reluctance to execute the trade.
Mm-hmm.
But I can certainly, on the flip side, also tell you I've never made a trade based on a chart that didn't have a fundamental or catalyst story.
Okay.
Mm-hmm.
I might say that I've never made a trade based on a short-term pattern without longer-term context, which is kind of maybe the technical version of that and kind of a bigger picture. Is there anything, what else should we be covering here?
I think we've covered a lot, especially for the first
we have.
module.
Yeah.
I mean, I'd get into some of the details of, Alex, what do you think of candlestick charts versus bar charts?
Yeah, I kind of felt like
the first module is very sort of, it's an overview and lays out a lot of the basic details about how to look at a chart.
Right.
So
we kind of maybe overwhelmed people with the first conversation, so I think maybe like.
Well, Alec, are you looking forward to the next module?
There you go.
Absolutely. Again, I'm very happy. I'm very impressed to be quite complimentary with this introduction and where I sense this is going. At a high level, I'm still quite skeptical of chart leading investment.
Mm-hmm.
And then secondarily, and this was probably a topic for another thing, another discussion is I get the sense the way you look at like portfolio level return and risk management is quite different from the way a lot of traditional investors would look at things.
Oh, it'd blow your mind.
Yeah.
Yeah.
Which I can tell you does not make me comfortable.
Yeah. There would be there could certainly be times that you could have your entire portfolio levered to a position. So say you're 150% in a position, and that position actually carries less risk than one you have 30% of your portfolio in.
I'm going to prima facie reject that concept.
Yes, I know you are. I know you are. But the whole idea. So you shift from when you're taking tactical positions and you're being paid on rather short term. I mean, they don't really have to be short term. They could be months to weeks to months. But when you're being paid on price movements and your relationship is to your potential loss, it's quite different. I mean, once you wrap your head around that, the portfolio math, which by the way doesn't really work that well, the portfolio risk management is horrifically loose compared to what you will have as a tactical trader. But yeah, I understand that telling you.
I mean, my guess then about the 150% example or whatever the numbers were, what you're talking about is short time frames and incredibly tight stop loss criteria, where even if you put 150% in, you're only going to allow a minimal downside.
A minimal downside and an instrument that is not particularly volatile. So if you had something that, and of course there's the problem that tomorrow's volatility might not be today's volatility.
Something could gap, you don't know.
But I mean, as we know in any kind of risk management, shit happens, and there's no way to ironclad yourself except just don't participate in the market. And one of the we would use the phrase a stop slipped. So getting a stop slip. So you're in at $100. You think you're getting out at 90 and the market opens at 80. So you have a bigger than expected loss. That's, of course, the risk. I would say one thing to kind of think about, I'm not a fan of very tight stops because the scenario I just outlined where your $100 thing opens at 80, that should almost never happen. Like it might happen at some point, but if you are in at 100 and your stop is at 99.50, there's a decent it's going to happen a lot. It opens at 95. And
Yeah.
then what multiple of your stop did you just get hit? So I tend to, and because I also believe, and here we are, comfort level and belief, I also believe that all of this is really only predictable within very fuzzy, wide bands. That all of this is very sloppy. And the market is very sloppy. My trading is not, but the market is very loose and sloppy and noisy. And so I can't exactly say, I get in here and I put a stop, I have to give it a little bit of room. And then the way it gets to the stop is, and then, we move the stop. So if you think you're risking those 10 points, you're probably not going to lose 10 points. You might lose 20, who knows? But you're probably going to lose 4 or 5 if you're wrong.
By the time the trade plays out, you've adjusted your stop and you reduce your risk over time.
So I guess I would, and I know it seems a little silly to give you homework, but I really think that I know all of these exercises probably seemed a little bit silly, and the idea of charting by hand probably seemed utterly ridiculous.
I simply didn't have the time, but obviously, yes, it feels like calculating long division in a world before a calculator.
Yeah.
But.
Well, there is that. All I can say is that I think I have a reasonably intuitive way of reading charts now. Is that? I mean, you've worked with me a lot, Tom. Is that?
I'd say that's pretty accurate.
Fair. And I think that and then I think about how do I transmit that to somebody else? That's not an easy thing to do. I think that one of the ways that I personally developed that intuition is to do a lot of this kind of chart, what we call the chart story, what happened here, what was going on. And yes, I just told you that you can't trade like that, that I think that kind of analysis in actual trading has very limited utility. But as far as training your brain to take the chart apart, it's a powerful tool. And so is the charting by hand. I don't know why, but I do know that I've had an army of people, literally hundreds of people, tell me that it's made a tremendous difference.
I mean, the other question that came to mind, and I was reminded of it because I was looking at the title on the chart, crude oil. If I come from, say, a macro perspective, and I have the following thesis, having read the news, talked with colleagues, etc., which is, there's going to be a flight from risk, so I'm going to cash and gold. I know immediately where I need to look.
Okay.
If you don't have a theory along those lines, how do you know what chart to look at?
You look at them all.
But practically, that's a practical limitation of time and
how
resource.
many charts do our scans look at?
Well, one of the issues with individual stocks is they're so tightly correlated. That's a legitimate problem. So I would say, personally, I probably on an average day look at 400 or 500 stock charts. My scans are looking at maybe 1,500. And if there's anything interesting that pops up, then I see it. Because I have defined patterns that I want to see, and we're running algorithms that pull the patterns out and say, hey, maybe you should look at this. And I would say 8 times out of 10, my answer is no. That's not really interesting. But as far as the macro charts, there's no reason anybody in the world can't look at every significant macro chart every day. You have a handful of currencies. Maybe you have, if we really stretch it, 20 currencies. There's really probably 7 or 8 you should be looking at. And then the price of, if we're considering the Western world, the price of maybe 5 or 6 traded commodities.
Yeah.
It's 5 minutes work.
And I'll plug our day stats here.
Oh, there you go.
And say that you can see it all very easily there.
Yeah, we have a tool that goes through and pulls out, it's hard you describe it. I talk about it all the time.
It just shows you all the major markets, where they are in relation to their open, and how much they moved on a volatility adjusted basis. Which
is one of the very interesting, that actually, so let's say you want to be lazy and you don't want to look at the 4D charts, you need to look at every day to see everything. Well, then what you could do is just look at the charts that made big moves. If only you had some way, and of course, I'm laughing because we tell people, these are the charts, you probably need to look at crude oil, natural gas after they make big moves. You probably don't need to look at gold while gold is sitting there not doing anything. It's probably the same price it was yesterday, more or less. And if you do this work on a fairly consistent basis, then you start to build up stories. You start to realize, which now we're back to the chart story thing. I know I'm not supposed to pound the table, but you would realize, well, crude oil's was going down. And then, I won't dazzle you with specific dates, but, and then it's been going up for the past few months. But now over the past several weeks, it's been trading in a way that it's been really going down, which it shouldn't be doing if that longer term up. So you start to kind of build these stories of the way these things work together. And it's really not that overwhelming.
Yeah, you can get a good overview of most major markets looking at 40 charts a day, which you can do in a few minutes, really.
Less than 5 minutes.
Yeah. I mean, that's obviously, presumably, hopefully the eye-opening exercise to come over the next few weeks. I mean, again, I would be reluctant to invest 150% of my portfolio in a market with which I'm not intimately aware or used to, and based on no, shall we say, real world story or catalyst. And that's perhaps the mental or psychological hurdle that I would have to overcome in order to fully embrace a sort of technicals first
I think
approach.
You also have a trust in the story that I don't. I believe that the news that is put out to make us watch the news. And by the time I hear something as a story, it's already been traded. It's already priced. It's already been acted upon. And if markets were efficient, you shouldn't have that. We're just looking at a chart that's basically going straight down. And I look at something like that, I'm like, I know probably what direction I want to be trading that chart.
Yeah.
All other things being equal, which of course is a thing.
Also, you should be skeptical because it's always obvious on the news, it's always obvious in hindsight why something happened.
That's true.
They always search for the reason something happened, like why the market went up or why it went down.
Sure.
Right?
I mean, clearly, if I'm waiting for CNBC to come out with a story, I'm too late. Yeah. I guess when I say a story, it's perhaps of my own concoction, putting a random 2 with another, random 2 and making like a tradable 4, shall we say. It should be unique. There's no question about that.
But if your story is unique, then what connection does it have with reality? You could lock me in a room and give me no information and say, make up a story about Indonesian stocks. And I can tell you a great story, but it has no connection with reality. And if you're talking to your coworkers at work, do they necessarily know what's really going on? We're talking about crude oil, for instance. Do they know where the tankers are? Do they know what decision some prince is going to make about output next month? No, of course they don't. I don't think anybody has, unless you're a specialist and you're paying a lot of money for access to the information like I just mentioned. Yeah. You don't have a story. You have a narrative. You have a made up story. You have a fairy tale, and maybe having a security. I think of those stories a lot of times, and I know the story sells, but the story to me is the security blanket, because we're always going to dissect the story 2 or 3 years down the road, and we'll know exactly what happened. But when you're there on the cutting, bleeding edge of the market every day, you don't know what the hell's going on. I never know what's going on.
Wow.
I don't think anybody really does. And I had this really driven home to me when I had a job where we monitored a big book. We had on hundreds of stocks, and we had to track down the stories for the stocks that made the big moves. And sometimes there was really no explanation. And we tried hard. Trust me, we called the company. We called people on the trading floor. We called the big banks. We had access. And sometimes, this stock moved 15% this day, and literally nobody knows. I can. There are times I can even we track down enough. I think we probably know who made the trade. Sometimes nobody knows why. So there are all who really knows.
Yeah.
You want to keep going, Alex?
That's probably a good place to wrap
Module
up.
2.
Oh yeah, oh absolutely, yeah, no, that's definitely.
Okay, module 2, and then we will reconvene.
So we'll see you again in a couple weeks, probably.
Excellent.
All right.
Thank you. So I hope you enjoyed that, and I'm going to ask you to do 2 things. Wherever you found this podcast, please leave a review. Very, very helpful. Helps other people find the work. And also, go check out marketlifetrading.com. Check out the course. See what it can do for your trading. I'll see you back very soon for another episode. Thank you very much.